Joining us now, Amanda Lynam. She's Chief Credit Strategist at Goldman Sachs. And I just want to bring up the chart here for you, Amanda, because you're expert at this. At Bloomberg, we have the total return indices that are just absolutely exquisite off of all the heritage of Lehman and Barclays as well. And the chart of the week is the Lynam chart here. And it's the great moderation of the bond market, price up forever, 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 7 standard deviation move. And we've come back. But come on, we've flatlined over the last 5 or 6 years. Does that mean bonds are of value, or does that mean you're still catching up?
Well, first of all, thank you for having me. Good afternoon. If you looked at that chart, Tom, and maybe you started it at year-end 2021, which is just before the Fed started hiking rates and just before interest rates really started their trend upward, what you would see is that IG bonds are roughly flat. However, high-yield bonds are up over 20%. Leveraged loans, floating rate, are up over 30% over that same time frame. So I think this speaks to the point that we've been emphasizing for a bit, and very relevant for your audience as well, is that there's an opportunity cost to being too defensive in this market.
Right.
Now, to answer your question on do bonds fit in a portfolio, absolutely, but they just can't be the only part. And that chart you showed told a great story in terms of what the rise in interest rates has done to pressure bond total returns, but at the same time, equities have enjoyed a pretty meaningful upswing. And so that's the point on diversification.
I've never asked this question. How long have I been doing this? It's like 7 or 8 years. I've never asked this question. How much of our 401ks in America are in boring, sleepy, underperforming bonds versus the high yield magic you just talked about?
I mean, our investors that are managing a lot of these 401ks on behalf of retirees and workers typically will employ pretty diversified portfolios. And then, as you know, there are target date funds that become less risky as you get closer to retirement. In general, that's a pretty good way to be invested. I think there's a difference between saving and investing in this market. And I think one of the big lessons is that being invested over the long term is really what is critical. It's hard to time over the arc of a career for any one rate backdrop or equity market backdrop. So staying invested and in a diversified portfolio is key. Saving and investing, I like that. When my son was born, my mother-in-law gave him a bond. Today, when kids are born, they have access to a Trump account. Their grandparents can contribute to that. These Trump accounts only invest in stock funds or ETFs. That sends a pretty strong signal about the role of bonds in building a portfolio, a person's financial future, doesn't it? Well, I think it's one part of an overall plan. But from my perspective, when we think about the role of a portfolio and where fixed income kicks in, it's really to provide income later in life that's more regular as opposed to waiting for an equity dividend. And then importantly, it's to offset periods of equity market weakness like we see today. And so while we've had a pretty meaningful uptrend in equities over the past few years, we've known from cycles that those don't go on in perpetuity. And so ideally, what you would want to have is some fixed rate exposure across the curve, some floating rate exposure. Actually, our portfolio strategy colleagues have been emphasizing the role of real assets and kind of inflation protection, and then typical equities, and it all fits together.
Goldman Sachs fixed income's recommending gold?
Our portfolio strategists. So our portfolio strategists who take a multi-sector view have basically made the point that, as you alluded to, the 60-40 portfolio isn't as straightforward as it was in the years past. And so given some of the shifts in the market, that we actually do have to incorporate things like real assets. In the stock market, individual investors are just as influential now as institutional investors. That's really changed over the last few years. I don't know who the dumb money is anymore versus the smart money. That line is blurred. Does that kind of blurring exist in the fixed income and credit world, or will this asset class always be the domain of institutions and professionals? We have a wide range of investors in our market. I think the really interesting bifurcation that I've seen in corporate credit over the past couple of years, but definitely recently, has been this bifurcation between investors who are buying bonds for yield versus investors who are buying bonds for spread and total return. And that is the key. And what we have emphasized is if you are allocating to credit right now, you should be buying for income and yield, not because there's material scope for a total return boost from tighter spreads because they're already tight, or from lower rates because our rate strategists are expecting rates to be elevated.
I want bond exposure to a data center in Ohio. Here is Amanda Lynam. She's been burning it up. Zero Hedge. She's a 30-page article and led with Amanda Lynam of Goldman Sachs. So here it is. A mix of markets will be required. Our equity research colleagues expect the 5 hyperscalers to invest a combined zillion trillion in AI capex to now 4 years out. It would push hyperscalers' weights well above the current market conventions. In our wealth management, are we going to be overwhelmed by this tech capex juggernaut?
This is the main debate in the corporate credit market right now. And just for your listeners, that number is $5.8 trillion that our equity colleagues
expect. It's not a zillion?
It's $5.8 trillion.
Yeah,
and I think what a lot of investors do is they will look at the hyperscalers' balance sheets and expect that will largely be financed with debt, and that a lot of that will come through the traditional IG corporate credit market. The point that we've made is that the bond market has issuer concentration constraints to a certain degree. And so the key takeaway there is that we expect a portion of that $5.8 trillion to be funded with debt, a portion of which will come through the traditional bond markets. But we also see scope for the private infrastructure market to play a role. We see scope for these new project finance JVs to do some of the heavy lifting. Cash flow from operations from the hyperscalers will contribute. We're also expecting equity issuance. Some of the rating agencies have said that.
So we shouldn't be afraid of this tech madness.
I am not concerned about an access to capital constraint. I just think as we progress through what is a multi-year investment cycle, that there will be more nuanced conversations around which market I should be accessing and at what price. That's largely a 2027, 2028 event, we think.
I want to take a step back here, because you think about the different generations, and Gen Z right now is graduating from college. They're joining the workforce. They're building up savings. They know about meme stocks. They know about crypto. They know about prediction markets. These are all go big or go home kinds of bets. Is there anything within the fixed income credit space that responds to that impulse?
Well, we're subject to risk sentiment like other markets are in terms of when there's a real risk-off tone. We feel it in our market. I would say we tend to be a bit more defensive. We actually put a piece out on this earlier this week, my colleague Spencer did, which really emphasized that the credit equity beta has diverged in 2026 in particular, meaning credit hasn't been participating as much on the upside, but it's also been more defensive on risk-off tones on the downside. And I think going back to over the arc of a career and investment cycle, just being invested is the key point.
Okay, I love that we're doing credit beta. But you're at this weekend at some family event or, friends and Romans and countrymen, and somebody says, should I buy a 5-year CD or a 3-year CD? America is still stuck in that question of personal finance versus a lot of
if they have any money to put in a CD to begin with.
Well, but the arch question is on duration. How short should I be right now?
So we like being more towards the front and intermediate part of the curve. At the longer end of the curve, so 30-year bonds, for example, it tends to be a bit more whippy. If your question is do we expect the Fed to be kind of cutting or hiking or holding pat from here, our economists are expecting the Fed to essentially be on hold through 2026. I would say the Middle East conflict has been flagged as an upside risk in terms of inflation, which does provide some risk to that view. But in general, we're expecting rates to remain on hold. So staying invested amid an elevated rate environment, you are actually earning some coupon from there as well.